All right, let's talk about one of the most misunderstood tools in all of finance, annuities. You've probably heard the term, and maybe it sounds a little, I don't know, complicated? Well, their main job is actually super simple. We're going to break it all down and demystify them so you can see exactly what they're for.
Let's start with the question that's probably on a lot of people's minds. It's the biggest fear for anyone planning for retirement, isn't it? You work your whole life, you save, and then you hit 85, 90, and the money's gone. Financial pros have a name for this. They call it longevity risk. But really, it just means outliving your money.
And that's it. At their very core, this is the one single problem annuities were built to solve. They offer a guaranteed income stream backed by a contract that you literally cannot outlive. It's like building your very own personal pension plan.
So what is an annuity exactly? Well, think of it this way. It's a contract you make with an insurance company. You give them a chunk of money, and in return, they promise to pay you a steady stream of income. It can start right away, or it can start down the road. That's why it's so important to think of it as an insurance product, not an investment like a stock or a bond.
This quote really nails it. An annuity isn't about chasing huge market returns or trying to get rich quick. It's about buying certainty. You are literally purchasing insurance against the great unknown of just how long you're going to live. It's about peace of mind. And you might think these are some newfangled financial product, but no way. The basic idea goes all the way back to ancient Rome. Annuities predate the retirement accounts we all know, like IRAs and 401ks, by centuries. That just goes to show you how fundamental this need for a guaranteed income really is.
So how do they actually work? Well, for most of them, there are two simple phases. First up, you've got the accumulation phase. This is when you're putting money in, and that money is growing without you having to pay taxes on it year after year. Then, whenever you're ready, you flip the switch and enter the payout phase. That's when the insurance companies start sending you those guaranteed checks.
Okay, but here's the thing. You can't just say an annuity. They are not all created equal. And the single most important difference between all the various types comes down to one thing: how your money actually grows during that accumulation phase. And that all depends on how much risk you're comfortable with.
Let's break down the three main flavors. First, you have a fixed annuity. Your principal is totally guaranteed and you get a low, predictable interest rate. Just think of it like a CD from an insurance company. Then there's an indexed annuity. This also protects your principal from market losses, but your growth potential is linked to a stock market index, giving you a shot at moderate returns. And finally, you have a variable annuity. This is where your money is invested in things that look and feel a lot like mutual funds. Your principal is at risk here, but your potential for growth is also the highest of the three.
Now, let's address the elephant in the room. Annuities have a reputation, and it's not always glowing. They get criticized for being too complex, too expensive, or for locking up your money. So let's tackle the biggest myth head-on.
This is probably the #1 thing you hear, right? That once you hand your money over to the insurance company, poof, it's gone forever, and you can't touch it. And in the old days with the simplest form of annuity, that was often true. You trade your lump sum for an income stream, and that was that. But things have really changed.
The modern solution is often an optional add-on called a Guaranteed Lifetime Withdrawal Benefit, or GLWB for short. This feature is a total game changer. It lets you get that lifetime income without giving up control of your underlying account value. You can start the income, you can stop it, and whatever money is left when you pass away can go to your family. It adds a layer of flexibility that just didn't exist before.
So to quickly recap the powerful benefits, #1, of course, is that guaranteed lifetime income. Then there's tax-deferred growth. For fixed and index types, you get principal protection, and depending on what state you live in, the money can be shielded from creditors, and it passes directly to your beneficiaries, skipping the whole lengthy court process of probate. But, of course, it's not a magic bullet. There are some really critical things to watch out for. The contracts can be incredibly complex, just loaded with jargon. The costs, especially for variable annuities and those cool optional features, can be high, and a huge one is liquidity, or the lack of it. So when we talk about lack of liquidity, what does that actually mean? Well, most annuities have something called a surrender period, and it typically lasts anywhere from 5 to 10 years. If you try to pull out a big chunk of your money during that window, you can get hit with some pretty nasty penalties. So this is definitely not money you might need for an emergency next year.
Okay, so you've got the pros, you've got the cons. It's all about this trade-off, right? Security versus flexibility and cost. An annuity is absolutely not a one-size-fits-all solution. So how in the world do you figure out if it belongs in your retirement plan?
Well, an annuity might be a really good fit if you're getting close to retirement and you just want that reliable pension-like paycheck. Or maybe you're a high-income earner and you've already maxed out your 401k and IRA and need another place for tax-deferred savings. On the flip side, you should probably be cautious if you're younger and can afford to take more market risk, if you think you'll need full access to your cash anytime soon, or if you haven't even maxed out your other retirement accounts yet.
At the end of the day, an annuity is just one piece of a much bigger retirement puzzle. It's a really powerful tool for one specific job, creating security and a predictable income you can't outlive. But it comes with those trade-offs in cost and flexibility. So now that you know the basics, the real question is, does that particular piece fit into your personal financial picture?